Hey, what's up, everyone? Welcome back to my world of stocks and welcome back to our stock market weekly update series where I round up the biggest news headlines of the week and I deliver them to you in a quick video. And this week is going to be jam-packed, guys, because we have earnings season officially kicking off here, including several big banks reporting, big airline stocks reporting, which, by the way, those two say a lot about the current state of the economy. So we'll run through them and what that means for us. As well as we also had several other big names reporting this week too, including PepsiCo, Taiwan Semiconductor, Netflix, and more. And we even have some more big tech news, including Nvidia's business in China, which one analyst thinks can actually send their market cap even higher than 5 trillion. But ASML, on the other hand, actually gave us an economic warning that we should be considering too. So all of that and more in today's video. Hope you guys enjoyed. Hit that like button if you enjoy these weekly updates, but let's just go ahead and jump straight into it, my friends. All right, now as always, we'll be starting here first with a quick recap on how the market performed this week. And so far on Friday here at the time of this recording, it is only slightly positive for the week on the heels of a fairly decent start to earnings season, with the S&P 500 climbing just a bit over 0.5%, but still breaking new record highs, while the tech-heavy Nasdaq saw even better performance, climbing more than 1.5%, and also breaking fresh new record highs too. As for the macro news though, of course, all eyes are really on earnings season right now, although we did actually get some inflation numbers this week too, which showed a slight uptick for CPI up to 2.7% in June, which was an increase of 0.3% on the month and 0.2% on core inflation. Now, this is not a huge increase, by the way. It's far from that. It's only really a small uptick, and as such, there's no real evidence here that tariffs are having any kind of major impact on inflation, at least not yet. But of course, most experts do think that that'll eventually come later on probably throughout the second half of the year. So we'll have to be keeping an eye on tariffs. Still commenting on the report here, President Trump did post on Truth Social, calling once again for the Fed to lower interest rates, saying, quote, "Consumer prices are low, bring down the Fed rate now. Fed should cut rates by 3 points. Very low inflation, $1 trillion a year would be saved." Again, we'll keep an eye on these inflation numbers, though, throughout the next few months. But for now, like I said, I think most eyes are really on earnings, which this week kicked off with big banks and big airlines, both of which, again, are heavily influenced by the economy and can oftentimes signal either a strong economy or a major slowdown or even looming recession because of how much they rely on business, traveling, taking out loans, spending, using credit cards, all those sorts of things that can accumulate interest for banks and make them more money too, right? Well, speaking of banks, they came out pretty strong this week with the 6 biggest U.S. banks generating almost $40 billion of second quarter profit, which is up collectively more than 20% year over year. So they're really raking in all that interest income, with JP Morgan leading the pack as the nation's largest bank, who crushed earnings this quarter, raking in about $15 billion alone, which is nearly as much as the next 3 biggest banks combined. How crazy is that, guys? Anyway, they beat estimates, and the CFO came out and said that their own indicators are signaling that the U.S. is really heading for a soft landing, at least from what they can tell, which means recession fears are going to be easing here, and U.S. consumers are still, in their opinion, holding up well, with loan growth even surging by 5% year over year. So people are still spending, still taking out loans. Bank of America, Citigroup, and U.S. Bancorp all beat estimates too on healthy deposit flows, strong loans and credit use, new accounts growth, and even highlighting new technologies powered by artificial intelligence that are helping these banks drive down costs too. So they're becoming a little bit leaner, running more profitably as well. And that's why you saw some pretty good earnings numbers for the quarter. I believe the only bank of the bunch, at least one of the few, that gave any kind of disappointing guidance was Wells Fargo. But they're usually an underperformer, in my opinion. So I don't know if I put too much weight on how Wells Fargo is doing themselves, but the stock fell over 3% since reporting their earnings, despite most other banks rallying, including Chase up around 1.6% for the week, while Citigroup soared the most at over 7% gains. Let me know if you own any bank stocks down below, though. Personally, I own Chase, I own US Bank Corp, and I also own SoFi. But overall, it looks like our high interest rates are, again, really helping these banks be more profitable at the moment. And that's probably being boosted by running leaner because of artificial intelligence and other technologies. By the way, BlackRock also reported some strong numbers this quarter too. They're already the world's largest asset manager, again, in the entire world, and they blew past earnings estimates with EPS surging by double digits at 16% growth year over year, while also growing their assets under management to a new record high of $12.5 trillion with a T. Absolutely mind-blowing. And yet the stock actually dipped initially following that report. I think it's due to rising costs from expansions and international investments to help them grow. But the stock later did rebound right back up again, as Wall Street likely realized that it's not too smart to be betting against this giant. Airlines, though, had a similarly positive result, with travel demand staying relatively strong despite numerous headwinds that have been really facing the industry all year long, like tariffs, high fuel costs, inflation, interest rates, things like that. But Delta, for example, posted record sales the week prior. They actually announced the week before this, but they slightly beat estimates, and they also raised their dividend by a whopping 25%. United reported this week, though, where revenue came in a little light compared to estimates, but was still positive growth of 2%, with EPS beating as well. Delta's CEO, Ed Bastian, noted that demand was strong in the quarter, especially for premium cabins and international flights, while United's CEO was quoted in saying that the world is less uncertain today than it was 6 months ago, while noting a positive uptick in bookings starting in July that he expects to continue throughout the second half of the year. So overall, pretty decent performance there from airlines. It looks like they're still doing relatively well with travel, and it looks like consumers are still willing to travel. Anyway, both stocks were actually relatively flat for the week after having already largely recovered from that horrible 2020 pandemic crash. And by the way, American and Southwest Airlines, I believe, will be reporting next week too. I don't personally own any airline stocks myself, though. Speaking about stocks, so let's shift over to some more individual stock news and some earnings and stuff. We did have a few more notable earning reports this week, including one of my favorites that I've been buying a lot of recently myself in PepsiCo, who I was happy to see that the food and beverage giant actually beat estimates on both sales and profits, despite the tough consumer market right now in the face of all these macro challenges. Speaking of which, volumes in North America actually declined for snacks and drinks around 1% and 2% respectively, but they were able to offset that weaker demand with growth overseas, as well as general price increases that also boosted overall sales. Now, going forward, the CEO highlighted recent initiatives like protein-based snacks and drinks, as well as reformulating their biggest brands to use all natural ingredients, thanks, of course, to that, those new health guidelines from HHS Secretary Robert Kennedy. The company has also seen higher demand for low sugar offerings like Pepsi Zero Sugar, for example, which happened to see double-digit volume growth in the quarter. So that was very good. And investors were, of course, pleased with the results, and that sent the stock rising almost 7% for the week, although it is still technically down more than a quarter of its value from the top, which I actually think is still pretty attractive for a dividend king here, yielding over 4% still on 52 years of consecutive growth. Very attractive. On the flip side, though, it was a pretty rough week for ASML, the Dutch company that makes those really high-tech lithography machines that are used by chip makers like TSMC, Intel, and Samsung to manufacture the world's most advanced semiconductors. Well, despite beating analyst estimates for the quarter, ASML stock actually fell over 10% after management warned that 2026 growth may come in flat and is largely due, and I think that's fiscal 2026 growth, but it's may come in flat largely due to macroeconomic uncertainty and rising geopolitical tensions, citing specifically tariffs for what could drive up prices for their machines by, they say, could be tens of millions of euros, potentially causing customers to delay or even reduce orders. So much so that they couldn't even confirm that they'd see any growth at all this year. And because ASML is a core supplier for the global chip supply chain, it really spooked investors into selling down, not just them, but even a few other chip stocks too, like Broadcom and AMD saw some little dips there too. Now, I actually really like ASML. I think that they have a very strong business, a competitive moat for the future of semiconductors. And if I didn't already own so many chip related stocks, I would probably consider buying on this dip here because it has now lost about a third of its value from the top. And I see them as a company here, a business that is still a very essential component, I would say, to the future of artificial intelligence and advanced computing. So it's a stock that I'll be keeping a close eye on. But hey, this was just another reminder that even the most dominant players aren't always immune to global headwinds, can always be dragged down. Now, that said, Nvidia actually saw much better performance once again, as this red hot AI leader just keeps on breaking new record highs after already breaking north of a $4 trillion market cap, the most in the world. This time climbing by another 4% this week after announcing that they will soon be selling again their H20 AI chips to China after receiving licenses from the US government. Now, as you guys might recall, the Trump administration had previously banned the sale of H20 chips. I think this was like back in April or something, but it was at least until they received these new special kind of custom licenses to sell them. Well, it looks like Nvidia went through all the regulatory hurdles for that, and they applied for those licenses, and it looks like they are now being granted these special licenses. They said in a new press release here that the US government has officially told them that the new licenses will in fact be granted to them, and so they can expect to be able to start delivering the chips once again here soon. But yeah, this is huge news, guys, because back in I think it was May, Nvidia's CEO had actually said that the ban that had occurred back then, it was cutting their market share in China by nearly half. It went from 95% to 50%. And that's a lot of damage there. As you'd imagine, with how big the Chinese market is, this is a move here now that can easily equate to many billions of dollars for them going forward, which was probably not being priced in by analysts, but can now, of course, be added to those equations. And so analysts from Melius, I'm not sure if I'm pronouncing that right, but Melius Research, they're actually predicting that Nvidia will soar past the $5 trillion market cap line. So not just $4 trillion, they're saying $5 trillion, and they raised their price target up to $235 per share, which would actually equate to around $5.7 trillion. That is mind-blowing, guys. Time will tell if that actually happens, but as of right now, I can tell you that I'm just happy to be a large Nvidia shareholder myself. I'm glad that it's one of my larger positions in my portfolio. And I would say the same likely goes for anyone invested in Taiwan Semiconductor, company that actually builds chips for not just Nvidia, but also Apple, AMD, and more. Well, they too continue to break new record highs after rising another 6% this week on the heels of a very strong earnings report where they not only beat estimates on both the top and bottom line, but they also grew profits by 60%, 60, thanks to continued demand driven by the trillions of dollars in expected AI spending that's been pouring in, where literally I would say at this point, the biggest tech companies in the world are basically fighting at this point to get their hands on as many AI chips as possible. And of course, TSMC happens to make a lot of them. Well, in fact, the company said that high performance computing, which includes AI chips, now accounts for over 60% of their wafer revenue, and they expect that number to keep growing rapidly larger. Now, the company is also speeding up some of their major expansions to capitalize on this momentum, with a second factory coming to Arizona in the US here that will be producing their world-leading 2 nanometer chips, and that'll be to support directly United States demand too. Now, they also raised revenue guidance up to 30% for the year. That's up from 20%. And there's really no sign of them slowing down at this point. Even with all the tariff headwinds, TSMC continues to look very impressive here. Let me know if you guys own it down below. Now, while Nvidia and TSM are leaders in the AI market, Netflix is of course a leader in video streaming, and they too had a great showing this week, at least in my opinion, dropping I feel like it was a very strong earnings report. On Thursday, they dropped this, where they not only beat estimates, but revenue and EPS both skyrocketed by 16% and a whopping 47% respectively, showing that the combination of both their higher price subscription plans as well as their newer and lower priced ad-supported plan are actually working for them as a combination there to attract new customers while still keeping existing ones. In fact, through the first half of this year, Netflix saw nearly half of all new US customers opting for the cheaper ad-supported plan, resulting in their ad revenues now expected to double this year, for which they're seeing even higher growth internationally too as they continue to expand. It's also likely that adding new types of content like sports, wrestling entertainment, boxing matches, live comedy shows, podcasts, all that type of stuff is really helping them diversify a bit and attract different types of viewers too. And yet, probably because much of the profit gains were internationally and due to a weaker dollar, coupled with the fact that the stock had already soared by huge amounts, it was already trading at a record high premium valuation, the stock actually sunk over 4% this week, despite, again, what I felt was actually very strong results. And that is something, though, that I have told you guys in the past, that if a stock is already priced to perfection, sometimes, you can't be too surprised if even perfect results won't be enough to lift that price because it's already kind of baked in. It's already kind of priced in. And look, you might argue then, how is Nvidia still climbing, right? I mean, aren't they priced to perfection? It's literally the most expensive stock in the world by market cap, or at least the largest, right? Well, first of all, Nvidia, in my opinion, is much more diversified. And I think it's also much more of an exciting business, in my opinion, but they're also much more profitable. And on top of that, their PEG ratio, price to earnings to growth, is actually 27% cheaper than the sector because of their strong margins, the really high earnings growth that is going to keep getting better over time. Whereas Netflix trades for a PEG that is 45% higher. And of course, Netflix spends a lot of money trying to create content too, and it can be very pricey for them, and that is going to hurt your margins too. But even with all of that aside, personally, I've just never really understood why so many investors like Netflix, which I admit, I guess I've gotten completely wrong because the stock keeps climbing, keeps breaking new highs. But for me, I just feel like, look, I know that it's a very popular service, but I would much rather just own something like Disney, Amazon, or even Google with YouTube. All of them, I feel, give me tons of exposure to video streaming, plus all the other gigantic and very profitable things that those other giant companies do as well. But hey, if you're invested in Netflix, congratulations on the stock climbing a lot so far. I guess this week wasn't that good for you, but let me know if you're happy about these results. How do you feel about them? And if you're holding on to Netflix stock long term, I'd love to hear your thoughts. Anyway, I think I'll wrap it up here, guys. I hope you enjoyed this week's update. We'll have, of course, more earnings updates coming for you next week too, so make sure you're subscribed. And I've got another video coming out this weekend, and I'll have much more videos coming out soon too. But hey, thanks again for stopping by, my friends. I hope that you're all doing well, and I will catch you in the next one. Take care. God bless you. Bye-bye.